When it comes to the investing world, there is a shining star named Peter Lynch. He's not just legendary, he's the Jedi of investors, he's an accomplished author and a former captain of the Fidelity Magellan Fundship. His strategies have made an unmistakable mark on the finance world, leaving a trail that speaks volumes about his prowess, whose insights keep fueling the fire of inspiration for generations of investors, myself included. In this video, we're skipping the highlights reel of his life achievements, many of those videos to go around. Instead, in this video, we're diving into some quick clips where Peter Lynch spills the beans on when to buy a company, when not to buy a company, his opinions on options trading, which is like trying to do financial acrobatics, his opinion on shorting, and finally, I will show you his favorite valuation method, which you can easily do yourself. Trust me, this will be more exciting than trying to assemble IKEA furniture. What's up, strangers? Welcome to the Wealth Game Nation. My name is Vedo and I'm here to help you better understand the Wealth Game and become part of the Wealth Game Nation. The first clip that we will look at is from an interview from 1997 where Peter talks about when to buy a company.
One thing you're trying to do is say, of all these public companies out there, here's the company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and you say, big deal. So you're trying to find companies you liked anyway. Right now you liked them. And now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise and then had a very, a 5-for-4 sale.
Here we see that Peter Lynch is looking for fundamentally sound businesses, which he then basically adds to his watch list. As he does not buy them right away, he waits for some outside factors to affect everything in the stock market and the prices drop from fairly priced to underpriced. Examples of this happening are more common than you might think. There are bad news on every corner and there are always things to worry about in the stock market. Think of October 2022. Every company in the stock market has gone down due to inflation data, recession fears, conflicts in Europe, etc. Extreme examples were tech companies like Meta and Nvidia. Then think of March 2020. Due to Rona, there was a massive sell-off in the stock market. This had very little to do with company performances. Then the housing crash of 2008, then the dot-com bubble of 2000, and those are only the market crashes. Then there are things like recession, inflation, monetary policy, world conflicts, and so on. Sometimes one company has bad earnings and then the whole sector sells off. Those are the things that Peter Lynch is looking out for when he's considering adding new company to his portfolio. The second clip is also from the same interview where Peter Lynch talks about when not to buy a company.
Just think of this as being, you say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. We say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to own it.
Here, Peter talks about valuations of companies and discounting of the future prices or earnings of the companies. If great things are already baked into the price of the stock, there is little potential for outsized returns. The company needs to execute near perfect just to break even with what is already in the price. There are many ways to evaluate a company. You can do discounted cash flow analysis, Benjamin Graham valuation, his risk premium ratio, multiples valuation, dividends valuation, Peter Lynch's valuation, etc. And in this video we will go over how Peter Lynch actually evaluates companies. Well, what Peter Lynch does is he uses a ratio called the PEG ratio, which he has popularized. PEG ratio stands for price to earnings growth. It is easily calculated and I will show you now how to do it. Here we can see I threw a couple of things into an Excel table to explain it more easier. First, let's look at the formula. The formula for the PEG ratio is simply the PE ratio, basically the price to earnings, divided by the expected earnings per share growth rate. In order to calculate this, we need only three things. That is PE, the dividend yield if applicable, and expected earnings per share growth rate. All this data is easily found out on any stock website. I prefer to use Stock Unlock, which is a website which I'm not affiliated with. I just like the guys who are creating the website and the service that they're providing. If we go to Stock Unlock and look at waste management, we can see that the forward PE is 24.69 and that the dividend yield is 1.75%. The only thing that we are missing now is the expected EPS future growth rate. We can look at the insights. This is based on analyst expectations. which of course is just a prediction. So we can look at it, but we should know that nobody can predict these things. These are only assumptions. We should always make our own assumptions. So here we see that 15.6 is the analyst expectations for future EPS growth for next year. Going back to the Excel table, we add here the future expected growth rate, as we saw that is 15.6, the dividend yield, which was 1.75, and price to earnings ratio. The original formula does not include dividend yield. However, I think this is very important to consider, as this is also a return that investors are getting in case the company actually pays those dividends. In case the company doesn't pay those dividends, we can just simply leave this at 0 and use the formula as it's written here. You can see the formula here. It is price to earnings ratio divided by projected EPS growth plus the dividend yield. And we get 1.42. Now, what does this ratio tells us? So according to Peter Lynch, everything below 1 is considered undervalued and everything above 1 is considered overvalued. Of course, the lower the number, the more undervalued the company is, and the higher the number, the more overvalued the company is. So here we see waste management, according to Peter Lynch's ratio, the PEG ratio is overvalued. That is because the projected EPS growth is much lower than actually the price of the company, according to the PE. Let's do quickly another example, United Health. If we go back to stock unlock, we can see that the forward PE is 18.99 with a dividend yield of 1.31%. And if we go to the insights and we look at the next year's projected EPS by analyst, we see that is 20.77. Going back to the Excel, I already plugged in the data. We see that the PEG ratio now comes out to be undervalued. It comes around 0.86. This is because the price to earnings ratio is lower than the projected EPS growth. It seems that United Health Group, according to Peter Lynch's PEG ratio, is undervalued. However, this is not financial advice. These are just examples to illustrate how to calculate the PEG ratio. Now that we know when Peter Lynch buys a company and when he does not buy a company and how he values companies, I still have 2 short clips that I want to show you that will give us more insights into Peter Lynch's investing philosophy. The next clip is on options and derivatives, also from the same interview from 1997.
Big deal. What about all the criticism of derivatives and the impact they have had?
That's a little complicated for me. All I know is, I mean, I don't know about derivatives.
For you?
It's way over my head. I've never bought an option in my life. I never bought. Time's on your side when you own a stock. You know, I don't know about putting 3% down and buying a future and a strap and a straddle. That's way over my head. Can't deal with that.
Is that right?
Let somebody else deal with it. Yeah.
I find Peter Lynch hilarious, which is besides the point. However, we saw in the clip that he never did options. He said they were too complicated for him. Of course, he's just being silly. I like his philosophy and I plan to follow in his footsteps here and never touch options. Not because I don't understand them, it's simply because there's too little upside and too much risk associated with options and derivatives. I will explain a little bit more about what he means by his comments about options and derivatives trading once we look at the 4th clip, which is 16 years apart from the first clip from 2013, and they're very much tied together. So let's look at the next one where he talks about shorting.
I mean,
well, I found the long...
They're obviously tracking some...
The hedge funds that have been on the long side have done the best. I mean, they may have a little bit by being short, but being right on the long side, because obviously if you're right, you can make, and that's, I would say when I ran Magellan, I might have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally, it offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So that's, when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be.
To break down some numbers, he said that being correct 3 to 6 times out of 10 times, when you are making a return of 2 to 3 times your money, you are much better off than shorting, where the upside is maximum 100%. This 100% would mean that the company or the stock market completely goes to zero. So if you're shorting a company, the company would need to go bankrupt and literally go to zero in order to make 100% on your investment. If you're shorting the whole market, of course, in theory, it can go to zero, but in practice, this is impossible. So your upside is only maximum 90%. So this is a risk versus reward ratio. There is simply too little upside and too high of a risk. And that's a wrap. Those are my top clips from my favorite investor, Peter Lynch. It's crystal clear why is he my top pick. He is no speculator, no market timer, no short seller, no frequent trader. He does not play the leverage game, he does not touch his options, nor derivatives. He's all about the basics, keeping it pure and laser focused on the fundamentals. As I journey toward my own big boy status and a full-grown wisdom, I've got the blueprint, and guess who's the architect? Yep, it's Peter Lynch. That's it for today. I hope you found this video useful. If you have any questions or comments, please leave them down below. In case you are interested in a full review of my stock portfolio, go check out my portfolio reveal video, link is in the description below. And if you're not already subscribed to my channel, please hit the subscribe button and share this video with your friends and family. I will do my best to create regular videos with updates of my portfolio. I will do more fundamental analysis and review other companies, their earnings, other investors' buys and sells, and everything around investing. Thank you so much for watching, and I'll see you in my next video.